Right, let me ask you something, right? Have you ever wondered what the actual difference is between insolvency, bankruptcy, and liquidation? Now, maybe you've heard these terms in the news, discussed down the pub, had a chat with your accountant, but you aren't quite sure how they apply to your situation, or if they apply to your situation. Now, if that sounds familiar, this video is exactly what you need. Now, today's video is all about clearing up some common confusion. We're going to dive into 3 terms that often get thrown around and mistook for one another: insolvency, bankruptcy, and liquidation. They're related, but they're not the same thing. Now, understanding the differences is going to be crucial if you're a limited company director, especially if your business is facing financial difficulties, starting to hit the skids. And by the end of the video, you'll know exactly what each of these terms mean, when they apply, and what they could mean for you and your company. So grab a cup of tea, grab a coffee, get comfortable, and let's get right into it. For those of you that don't know, it's Chris Worden, Director First. Welcome back to the channel. Now, what we do here is we try and make insolvency easy to understand. We cut out the bullshit and give you information in really easy to understand terms. Now, all our advice is free. Please subscribe, like the channel. Now let's get back to it. What I'm going to talk to you now about is understanding insolvency. That's where we'll start. And insolvency is the broadest of all 3 terms, and it can basically apply to both an individual and a business. And in simple terms, insolvency means that an entity, whether it's me or my company, cannot pay its debts as they come due. Now, there are 2 types of insolvency to be aware of. One is the cash flow insolvency, and this is when a business can't pay its bills as they fall due. Even if the company's assets exceed the liabilities, let's imagine you've got 100 grand's worth of kit, but you can't access the cash quickly enough, and you can't pay your 10 grand HMRC bill. That's cash flow insolvency. Second one I want to talk to you about, balance sheet insolvency. And this occurs where the company's liabilities exceeds its assets. So even if the company's making payments on time, technically it's insolvent. Because if on paper it owes more than it owns. And insolvency is a serious issue, because it's normally the first sign that a business is in trouble. And if you don't address it, it's going to lead to more serious consequences down the line. Very much like toothache. You get toothache and you don't go and see a dentist, that tooth is going to get worse and the pain is going to become unbearable. Now, the consequences to not, paying attention to insolvency could be bankruptcy, could be liquidation for the business. And for UK directors, it's important to recognise signs early, so then you can take action to try and protect the company or yourself personally. Now let's move on. Let's talk about bankruptcy. Now, bankruptcy is a legal process, and it applies to individuals and sole traders, not limited companies. If an individual is insolvent and it can't pay its debts, they, like the person, can apply to become bankrupt, or a creditor of the person can force them into bankruptcy, and it's through a court order. Now, in the UK, bankruptcy is a way of drawing a line under your debts. It involves basically a legal declaration that you cannot pay your debts, and it gives you a fresh start, free from those debts after a certain period, and it's typically 12 months. Now, however, bankruptcy also means that most of your assets, if you've got any, will be sold to repay the creditors. Obviously, if you've got no assets, there's nothing to sell. And it's going to have a mega impact on your credit score. You're not going to be able to get a packet of fags on tick for the next few years. You're not going to be able to get any credit in the future. Well, not in the future. I'd say it's going to take you at least 5 years to repay your credit worthiness. Now, for a company director, it's important to understand that while a company can become insolvent, can't pay its debts when they fall due, liabilities more than the assets, it cannot become bankrupt. Instead, an insolvent company might go through liquidation. I'm going to talk about that next. I get a lot of directors who call me up and say, Chris, do I need to bankrupt my business? Is it business bankruptcy? Now, the idea's right, they've just got the words confused. Let's talk about liquidation. If a business is becoming insolvent, one of the options is to liquidate the business. And there are a number of different types of liquidation. Now, remember, liquidation is specifically related to companies, and it is the process of winding up a company's affairs. If the company's got assets, it involves selling the company's assets, pays the creditors, and then they dissolve the company. Remember, there are three types of liquidation. The number one and most common one for businesses that become insolvent is a voluntary liquidation. Okay? It's called a CVO for short. The director realises the company can no longer pay its debts and they decide to voluntarily wind it up. They've got to find a licensed insolvency practitioner, and that insolvency practitioner oversees the liquidation. If there's any company assets, they sell the company assets. If there's any overdrawn directors' loan accounts, the insolvency practitioner is duty bound to recover those directors' loans and again distribute any proceeds to creditors. The other type of liquidation you want to be aware of is a compulsory liquidation, and this occurs when a creditor takes legal action to force a company into liquidation. So the creditor gets a winding up petition ordered at court, and if the court grants it, the company gets wound up. You've got to avoid this. If you are a director out there and someone threatening to wind you up, you need to take it very seriously and pick up the phone to somebody like me, because when it's a winding up petition, this is where disqualifications happen, personal liability notices happen, and you've got an option, haven't you? Become insolvent, you can either go on the voluntary route, which is what you're meant to do, or you wait and bury your head in the sand and you get wound up by the courts. The latter always involves worse consequences. If you get wound up, the official receiver is appointed, and it's the official receiver who liquidates company assets. Now, the third type I want to talk about is a member's voluntary liquidation, or an MVL for short. And the liquidation is used when a company is solvent. All that means is the company can pay its debts when they're due, but the directors don't want to carry on. They want to wind it up. Now, it might happen if the company's fulfilled its purpose, directors want to retire. In an MVL, the assets are sold, all debts are paid, and any remaining funds are distributed to shareholders. Now, it's my personal opinion, obviously in an MVL you're still going to need a licensed insolvency practitioner. It's not really worth you looking at an MVL unless you can pay everyone off and say you've got at least 25 or 30 grand to distribute to shareholders. Anyway, each type of them liquidations has different implications, both for directors and shareholders, so it's really important you understand which one applies to your situation if you're thinking of closing your company and if you think the company's got financial difficulties. Now, let's move on. Now we've covered insolvency, bankruptcy, and we've covered about liquidation, we're going to talk about the key differences and why they matter. And some of the stuff I'm going to do is we're going to repeat, but it's just important that I drill it into your head. Again, insolvency is the broadest term. It can apply to an individual, it can apply to a company. Bankruptcy is a specific process for an individual, while liquidation is the process used to wind up a company's affairs, generally when they're insolvent. Now, what's the application of these types of things? Bankruptcy applies to individuals and sole traders. Now, if a company is insolvent, it doesn't go bankrupt, it goes into liquidation. Now, insolvency is like a state of financial distress. Remember, bankruptcy is a legal process that helps the individuals deals with insolvency, and the liquidation is the process of closing down an insolvent company and then distributing its assets to creditors, if there are any assets. Now, if you can understand these differences, it's quite important for a company director because it's going to help him or her navigate the legal and financial challenges any business might face. I'll give you some examples. If your company's insolvent, you need to act quickly, because then you're going to avoid things like wrongful trading while insolvent. Then things could actually lead to personal liability if you end up in liquidation. Now, what should you do if your company's actually facing insolvency? Well, there's a whole range of options, but the most important thing you need to do is really to pick the phone up. You've got to act quickly and responsibly. Now, like I say, seeking professional advice is critical, because the sooner that you take that advice, the more options available that you've got. We can assess your situation, basically advise you on the best course of action to take. Now, you might need to stop trading. Normally this advice will follow on from speaking to somebody like me, but if you do continue trading while insolvent, that's it. could land you in hot water down the line, especially if you're continuing to trade, you're taking deposits, you are racking up more bills with no hope of ever actually fulfilling this work. Now, it's really important that you communicate with creditors. So if you communicate with people, you can normally get some better terms with them. You know, you might need extended payment deadlines, reduced interest rates. And if you communicate with your creditors, what it stops them doing is winding the company up. I know it's dead tempting, like, I don't know, you owe HMRC, you bloody owe your suppliers, you don't want to have another bad phone call. But if they don't hear anything from you, you're just going to go down that debt collection process with this customer, and eventually they're just going to go, right, I'll wind the business up. Another thing you want to look at is rescue options. You know, not every in fact, most conversations with me do not end up in liquidation. There are loads of ways to rescue a business that's become insolvent. One of the things that might work for you is a company voluntary arrangement. It's a CVA for short, or maybe getting the business into administration. Now, these can actually provide a bit of breathing space so you can restructure company debts and hopefully return it to profitability. Now, if you have to consider liquidation, if there's no realistic prospect of saving the company, a liquidation might be the best option. And what it'll do, it'll allow the company to wind up its affairs in an orderly manner, hopefully minimising the impacts on creditors, and it allows you to move forward. Now remember, if you're going to liquidate your business, one of the things you might consider is pre-packing some of the assets. So let's say, I don't know, you are a builder with some vans, some tools, you've got behind, let's say with HMRC and some suppliers, you've not been paid off one of your clients, it's caused huge issues on your cash flow, but you've got some hope. You believe that without that legacy debt, you could make a success of it. Well, you could decide to purchase the assets of that business and take them over to a new company. Now, the strict stuff that you've got to follow, you'll have to get your assets valued by an independent valuer. You need to keep in touch with an insolvency practitioner throughout this process. But as long as you sell those assets for fair value, which is deemed by a valuer or an agent, you can move them into a new company and start again. Now, all this stuff is quite serious. There's loads of legal responsibilities. And as a director, you've got to take them seriously, especially when your company's insolvent. And it's really crucial that you understand these to avoid personal liability. Number one, you've got to act in the best interests of your creditors when your company becomes insolvent. It's like your primary duty is now to your creditors and not to your shareholders. Now, what this means is making decisions that protect the creditors' interests. You know, that might be stopping trading. It might be preserving company assets, cash in the business account. You've got to avoid wrongful trading. Like, wrongful trading occurs when directors continue to trade. They know they're never going to avoid insolvency. And if you get found guilty of that, you could be held personally liable for lots of companies' debts. Like the BHS directors, they have been done for millions and millions and millions. So to avoid this, seek professional advice as soon as you suspect insolvency. And hopefully, you'll get it early enough that there's loads of options and you don't liquidate. And remember, you've got to maintain proper records, keep them accurate, keep them up to date. You know, records of all company transactions, meetings, decisions. You know, if you become insolvent but you're going to keep trading and you speak to somebody like me and I say, well, actually, you're probably better off seeing what has happened in the next month, get it down on a board meeting. If you're going to sell some assets to get some cash into the company to keep trading, make sure you put minutes of these decisions down because they might help you in a liquidation. Now, if you enter liquidation, you're going to be asked as to why the company's failed. So if you can show them board minutes that you've been acting in the best interests of creditors, it's going to help your position and it's going to help you demonstrate that you have acted responsibly as a director. Now, one thing you need to avoid is preference payments. Don't prioritise payments to certain creditors over others when the company's become insolvent because it could be seen as giving them preferential treatment and it can lead to legal action against you personally. And the easiest way to explain that is, I'm insolvent, I've got a funding circle loan of 50 grand that I've personally guaranteed, I owe the revenue 50 grand, the supplier 50 grand, and what I do in the last 2 months is I pay down my funding circle debt, and I give 2 fingers to the other creditors. You've clearly done that. You've preferred them to everyone else to feather your own nest. That's going to get you in trouble. Now, I hope you found the video useful. For you to understand the differences between these things, insolvency, bankruptcy, liquidation, it is vital for everybody who's watching. They're not legal terms, they represent real financial challenges that could affect your business and your personal life. So the key takeaway from today's video is that insolvency, remember, is a state of financial distress, and it can lead to bankruptcy for individuals or liquidation for companies. Now, if your business is showing signs of financial difficulties, please don't wait. Take action now. Seek professional advice, understand your responsibilities, and explore all options. I hope you found the video useful. My name is Chris Worden. Thanks for your time. God bless.